Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at CoreWeave.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we break down the really dramatic price action on today's chart, there's a highly useful tool for investors who are trying to cut through all the market noise.
Right.
If you want help reading trading charts with actual clarity, you can check out VIP Algos through the link below in the description.
Highly recommend it.
Yeah, VIP Algos is a TradingView indicator suite, and it's designed to give you a structural edge. It provides visual buy and sell chart alerts, distinct trend direction tools, mapped out support and resistance zones, and areas specifically for take profit and stop loss planning.
Which is huge.
Exactly. And it works across stocks, Forex, crypto, gold, indices, futures, you name it. Now, just a crucial reminder here, VIP Algos is purely an educational chart analysis tool.
Right. It's not financial advice.
No, it is not financial advice. It does not place trades for you, and it absolutely does not guarantee profits. Trading always involves risk, so you must manage your own capital and do your own research. And because this is an affiliate link, we may earn a commission if you use it, but at no extra cost to you.
Perfect. So, put yourself in this scenario for a second, right?
Okay.
You open your brokerage app, you're looking at your portfolio, and you see a stock you believed was like a cornerstone of the whole artificial intelligence boom down 15.1% in a single day.
Oh, man. Yeah.
That is the reality for CoreWeave shareholders right now. Just a massive, staggering gap down. And, when you see a high-flying tech stock suddenly and violently crater by 15%, it triggers a very specific kind of pit in your stomach.
It absolutely does. That kind of sudden downward velocity, it just demands immediate attention.
Right.
But it also presents a really fascinating puzzle for anyone trying to navigate this market.
Which is exactly what we need to figure out for you today. Are we looking at a completely rational mass exodus? Like just blind narrative-driven panic selling because rumors are swirling that Meta is going to jump into the cloud space and crush everyone's margins?
Yeah, that's the rumor.
Or is the broader market getting this completely wrong? Is this creating a rare, incredibly asymmetric entry point into the AI infrastructure supercycle?
And see, that is the multi-billion-dollar question. When a chart breaks down that violently, the worst thing you can do is react emotionally to the daily noise.
Right, you can't just panic.
Exactly. You have to strip away the panic and look at the actual structural foundation of the business itself.
All right, let's move into wealth building context.
So to even begin evaluating if this stock belongs anywhere near a long-term portfolio, we really have to define what CoreWeave actually does.
Okay.
They operate in a category called the neocloud.
Okay, let's pause right there because the tech industry just loves inventing new jargon.
They do, yeah.
What makes a neocloud different from just the regular cloud? Because when you say cloud, I immediately think of the massive hyperscalers, right? Amazon Web Services, Microsoft Azure, Google Cloud.
And that is the crucial distinction to make here. Think of those legacy hyperscalers like massive, sprawling public highways.
Okay.
They were built over the last 2 decades to handle general traffic. So hosting websites, running basic corporate email servers, store your family photos. They're generalized.
Right.
But because they are generalized, they have massive congestion and inefficiencies when you try to run something highly intensive on them.
So where does a neocloud fit into that analogy then?
So CoreWeave is building a private, highly controlled Formula One track engineered specifically and exclusively for AI vehicles.
Oh, wow. Okay.
Yeah, they aren't renting out excess general server space. They provide multi-tenant, SLA-backed AI workloads.
Okay, let's break down SLA-backed for anyone who isn't, a systems architect, because that sounds like more jargon, but I know it's actually the absolute key to their entire business model.
It is. So SLA stands for Service Level Agreement.
Right.
Training a massive artificial intelligence model is incredibly fragile. If you're a company spending, say, $50 million to train a new AI, and the server blips for even a fraction of a second.
It's a tiny blip.
Yeah, or if the computing speed drops even a little, your entire training run can be corrupted.
Oh, man.
You literally have to start over. And legacy clouds, they struggle to guarantee flawless, uninterrupted performance for workloads that heavy.
But CoreWeave can.
Yes. CoreWeave legally guarantees that uptime and that processing speed. That is the SLA.
Yeah.
And if they fail, they pay a massive penalty.
Okay, well, that makes the value proposition much clearer. But, putting my cautious investor hat back on for a second, I still have to challenge this setup.
Sure.
We are talking about building wealth over a 5 to 10-year horizon here. And a stock that can plummet 15% in a few hours is inherently destabilizing to a portfolio.
It is.
So how do you justify holding something with that level of extreme short-term volatility? Doesn't it sort of cross the line from investing into just pure speculation?
It's a totally valid concern. I mean, it really is. The wealth-building thesis here is definitely not for the faint of heart, but it is anchored to something highly tangible, which is a massive multi-year contracted backlog.
Okay.
This is the ultimate picks and shovels play of the AI revolution. During the gold rush, the people who consistently made fortunes weren't the gold miners.
Right.
They were the people selling the pickaxes and the shovels.
And CoreWeave is selling the digital shovels.
Exactly. They are providing the physical infrastructure, making this entire tech boom possible. If you want to capitalize on that hypergrowth, the cost of admission is stomaching intense, headline-driven volatility.
You just have to write it out.
You do. You have to possess the discipline to look past a brutal week and focus on a multi-year horizon.
All right, so if we're buying into the infrastructure of the future, we just have to be willing to endure a very bumpy road.
That gives us the bigger picture. Now let's look at the fundamentals.
And the fundamental numbers here are honestly staggering, but in completely opposite directions.
Yeah, they are.
So on the top line, in the first quarter of 2026, CoreWeave brought in $2.08 billion in revenue.
Huge.
That is up from just $982 million in the exact same quarter last year. So they essentially doubled their revenue in 12 months, which is incredible.
It proves that the market demand for their specialized high-speed F1 track is almost insatiable, right? I mean, they are scaling at a speed most companies can't even model in a spreadsheet.
But, okay, let me stop you there, because if we flip to the bottom line, it paints a very dark picture for anyone who cares about profitability.
Right.
Their adjusted operating margin didn't just dip. It plummeted from 17% all the way down to a razor-thin 1%.
Yeah.
And the net loss, it ballooned to a terrifying $740 million.
It's a big number.
I mean, if I came to my spouse and said, great news, I doubled my income, but we're also running a $740 million deficit, I'd be sleeping on the couch for a decade.
Oh, absolutely.
So how is that level of cash burn not a glaring, flashing red alert?
So on the surface, yes, a $740 million hole looks disastrous. Right. But you have to investigate the mechanics of why they're burning that cash.
Okay.
This isn't like a software company burning money on lavish marketing campaigns or failing to find customers. This is the brutal reality of physical infrastructure. CoreWeave is aggressively front-loading their capital expenditures.
Meaning they have to pay for the building before they can rent out the apartment?
A very, very expensive building, too. I mean, building a purpose-built AI data center requires securing hundreds of acres of land, negotiating massive power grid access, which, by the way, takes years, buying tens of thousands of NVIDIA's most advanced GPUs, and installing liquid cooling systems.
That's a lot of upfront capital.
Right. All of that cash goes out the door long before a single customer plugs in and starts actually paying them. So the margin contraction is purely the friction of physical expansion.
Okay, I follow the logic of the upfront costs, but how do they survive that valley of death? Like, how do they avoid running out of cash before those data centers are actually operational?
Well, this is where we get to the single most important number in this entire analysis. $99.4 billion.
Their contracted revenue backlog.
Yes, as of March 31st, 2026, they have $99.4 billion in contractually guaranteed future revenue. And that includes a massive $21 billion commitment from Meta that they signed earlier this year.
Wow. Let's unpack the power of that backlog, because it isn't just a promise, right? It functions as a financial instrument.
Exactly. Think of it like collateral. When CoreWeave walks into a bank or approaches a private credit market and says, we need billions of dollars to build a new data center, the lenders don't just look at the $740 million current loss.
Right.
They look at the $99.4 billion locked-in backlog from blue-chip tech giants. It provides near-perfect earnings visibility. It proves their pricing power is intact and allows them to finance these astronomical upfront costs securely.
That gives us the business picture. Now let's move to the catalyst timeline.
So the most immediate hurdle approaching is the Q2 2026 earnings report. Analysts aren't going to care much about a flashy narrative, They are going to demand to see execution.
Right, show me the money.
Exactly. The entire focus will be on the pace at which CoreWeave is physically converting that 99.4 billion backlog into recognized top-line revenue.
And the bottleneck for that conversion isn't demand, right? It's electricity.
Absolutely. The other major operational metric will be their active power capacity. So they ended Q1 with a little over 1 gigawatt of capacity.
Okay.
And to put that in perspective, a gigawatt can power roughly 750,000 homes. CoreWeave's stated goal is to push their capacity beyond 1.7 gigawatts by the end of the year.
Because without power, a $50,000 GPU is just a really expensive paperweight.
Exactly.
So how are they getting there? What are the operational catalysts?
Well, that brings us to their recent operational milestones, which are actually solving very specific friction points in the AI ecosystem. For instance, in late June, they launched ARA.
What exactly is ARIA, and why should an investor care about it?
So ARA is an AI research agent that they embedded directly into Weights and Biases, which is this massive developer platform.
Okay.
Essentially, it's a tool that automatically optimizes the workflows for the engineers actually building the AI models. It makes the customers' lives dramatically easier, which makes CoreWeave's ecosystem much stickier.
So it's about locking the developers into their specific infrastructure.
Yes.
What about the physical expansion side of things?
Well, they just secured a massive European co-location deal with Canapto, and it's powered entirely by renewable energy.
Okay, why does a European deal move the needle so much?
Because of two massive roadblocks over there: data sovereignty laws and European grid restrictions. Europe has incredibly strict laws dictating that European user data must be processed within European borders.
Right, they don't mess around with that.
No, they don't. And furthermore, European power grids are highly regulated regarding carbon footprints.
I see.
Yeah, so by securing a green energy co-location deal inside Europe, CoreWeave instantly bypasses both of those bureaucratic nightmares, opening up this massive new revenue pipeline that legacy clouds are currently just really struggling to navigate.
That is a massive structural advantage. And they also announced a multi-exabyte storage partnership with Backblaze, right?
I assume that addresses the sheer data gravity of AI.
Exactly. I mean, artificial intelligence consumes oceans of data. You cannot train an AI if your compute power is in one state and your data storage is thousands of miles away.
The lag would be terrible.
The latency just kills the process. So the Backblaze partnership ensures that massive multi-exabyte data lakes are stored right next to the compute engines. And all of this is happening against a very favorable macro backdrop too, right? I mean, Meta just released their 2026 CapEx forecast, projecting an incredible $125 billion to $145 billion in capital expenditures.
It's just wild.
It is. And that signals to the entire market that the arms race for AI infrastructure is actually accelerating. And then if you combine that with the macro interest rate environment, I mean, consider this. If we see any future rate cuts, the interest CoreWeave pays on the billions they are borrowing to build these centers will drop significantly, which flows straight to their free cash flow.
Catalysts tell us what could change the story. Now let's pivot to the chart.
Okay, looking at the price structure, we just cannot ignore the severity of that 15.1% drop. I mean, a gap down of that magnitude is a massive structural breakdown.
Oh, totally.
It shattered short-term support levels. And if you look at the volume accompanying that drop, it paints a picture of pure narrative panic. The moment rumors hit the wire that Meta might start selling their own excess AI compute, retail investors just rushed for the exits.
Yeah, they panicked.
They completely disregarded all the technical support zones that had been building for months.
It looks catastrophic on a daily chart, for sure. But this is where understanding market psychology becomes your greatest edge.
How so?
Historically, when you see a violent, high-volume gap down, driven purely by unconfirmed rumors rather than a fundamental business failure, it often triggers what's called a capitulation bottom.
Okay, explain the mechanics of a capitulation bottom. Like, what is actually happening in the order books?
Think of it like a controlled burn in a dense forest.
Okay.
For months, a stock builds up this dead brush. Speculative day traders, short-term momentum chasers, people holding on high margin. When a terrifying rumor hits, all that dead brush catches fire and burns out immediately. The weak hands sell in a panic, accepting massive losses just to get out.
Which creates incredible downward pressure on the price.
Right. But once every panic seller has finally sold, the selling pressure is completely exhausted. The forest floor is cleared.
And who steps in?
Institutional money. The smart money that has been waiting for a discount sees a company with a $99.4 billion backlog suddenly trading at a 15% discount because of a rumor.
Wow.
So they begin aggressively accumulating shares, establishing a new, much stronger psychological base with deep roots. Think of it like a rubber band stretched too far by panic. It sets up a highly asymmetric entry point where the downside is exhausted, but the long-term upside remains fully intact.
So the chart gives us price structure. But what does market sentiment look like? Because, I mean, if you gauge sentiment just by scrolling through social media or reading financial headlines right now, the narrative is suffocatingly bearish.
Yeah, the doom and gloom is everywhere.
It really is. The prevailing anxiety is that NeoCloud shareholders are about to be left holding the bag. The fear is simple. If Meta, with their infinite resources, starts flooding the market by selling their excess AI compute, it will crash the pricing power of the entire industry.
Right.
CoreWeave's premium pricing model would instantly collapse.
See, that is the loud retail-facing fear.
Right.
But there is a massive disconnect between what the headlines are screaming and what the actual analysts tracking the institutional money are doing.
Really?
Yeah. Despite that 15% drop, Wall Street analysts maintain a consensus overweight rating on CoreWeave. They aren't downgrading the stock. They are looking at the math and treating this sell-off as a massive mispricing event.
But why aren't the institutions terrified of Meta entering the cloud space?
Because of what Meta entering the space actually represents. Let's assume that the rumor is entirely true, right?
Right.
If a titan like Meta is willing to fundamentally reorganize their corporate structure to sell cloud compute, what does that tell you? It validates that the total addressable market, the TAM, for AI compute is so astronomically large that even Meta can't ignore it.
Ah, so it's a signal that there's more than enough pie to go around.
Exactly. Furthermore, it acts as a massive speculative catalyst for M&A activity.
Mergers and acquisitions. Walk me through that logic.
Well, if you are a traditional legacy cloud provider, say Google or an Amazon, and you suddenly see Meta entering the specialized AI cloud space, while pure-play neo-clouds like CoreWeave are already dominating the SLA-backed enterprise market, panic sets in.
Right, you're getting left behind.
You realize your generalized infrastructure is losing the AI race. Instead of spending 5 years and $50 billion trying to build your own specialized neo-cloud from scratch, what do?
You buy one that already exists.
Exactly. This dynamic creates an incredible valuation floor for companies like CoreWeave because they instantly become prime acquisition targets for legacy giants desperate to catch up. That sentiment picture is useful, but we still need to talk about the risks.
And I definitely want to lean heavily into the bear case here because this company is carrying some monumental risks. Let's start with customer concentration.
Yeah, that's a big one.
Last year, Microsoft accounted for approximately 67% of CoreWeave's entire revenue. Now, adding Meta's $21 billion commitment helps diversify that slightly, but the reality is their entire business model is heavily dependent on a handful of mega-cap tech giants.
True.
So what happens if Microsoft decides they are tired of paying CoreWeave's margins, builds out their own specialized internal F1 track, and simply severs the relationship? I mean, CoreWeave's revenue would evaporate overnight.
That concentration risk is undeniably the heaviest weight on the bear case. It is a very real vulnerability. However, the mitigation of that risk requires understanding why these giants use CoreWeave in the first place. Building general internal compute for Microsoft's everyday operations is very different from engineering a sovereign SLA-guaranteed platform exclusively for heavy AI workloads. CoreWeave has mastered a very dark art of hardware orchestration that is incredibly difficult to replicate, even for a Microsoft.
But assuming Microsoft could figure it out eventually.
They might, but they cannot simply sever the relationship tomorrow. CoreWeave doesn't operate on, like, month-to-month handshakes. They lock these hyperscalers into ironclad, multi-year contracts.
Ah.
Yeah, many of these agreements extend all the way through 2032.
Which perfectly transitions to the second and perhaps more terrifying risk, the debt.
Right.
We discussed earlier that CoreWeave is planning to spend $31 billion to $35 billion in capital expenditures in 2026 alone.
Massive numbers.
You do not fund that out of petty cash. They are taking on mountains of corporate debt in an environment where interest rates are still historically elevated. If rates stay higher for longer, the sheer cost of paying the interest on $35 billion could completely suffocate their cash flow. They could literally grow themselves into bankruptcy before they ever turn a real profit.
It's true. The leverage they're employing is akin to walking a tightrope without a net. If macroeconomic conditions deteriorate rapidly, that debt burden becomes incredibly oppressive.
Yeah.
But those ironclad contracts stretching to 2032 are exactly what secure the debt service.
Oh, they use the contracts as a shield.
Exactly. Private equity and institutional lenders are willing to finance that $35 billion build-out, specifically because they can verify the $99.4 billion backlog.
Right.
They can mathematically model the guaranteed cash flow required to service the debt for the next 6 years. It's a highly leveraged, aggressive strategy, but the safety net is woven directly out of those legally binding enterprise commitments.
So with everything on the table, what's the final verdict?
Based on the structural analysis, the underlying fundamentals, and the macro tailwinds, the research concludes with a bullish score of 8 out of 10.
Wow. Okay.
Yeah, the core thesis is this. The recent 15% market plunge is a severe emotional overreaction. It is driven by rumor-based panic that completely ignores the reality of a nearly $100 billion contracted backlog.
Right.
The overarching, insatiable demand for physical AI compute, combined with the validation of the neo-cloud market, heavily outweighs the short-term fears of pricing compression.
Makes sense.
However, this is a multi-year target horizon. The thesis requires patience as those physical data centers are built, powered up, and begin actually converting that backlog into recognized revenue.
And as always, a vital reminder to you listening, we are just outlining the conclusion of a research framework today. This is not direct financial advice telling you to buy or sell or hold this asset. Every single investor has a different timeline and risk tolerance.
Absolutely.
A company carrying this much debt and experiencing this much volatility requires careful, independent consideration.
Always do your own diligence. But as you evaluate this space, I want to leave you with one final, broader perspective to consider.
Right. What is it?
So for the past 2 years, the entire market has been obsessing over the software, the large language models, and the microchips driving the AI revolution, right?
Sure, the flashy stuff.
Exactly. But what if the ultimate bottleneck to human advancement isn't the technology itself? As physical data center space, advanced cooling systems, and sheer electrical grid capacity become the scarcest resources on the planet, are specialized sovereign neoclouds like CoreWeave quietly positioning themselves to become the new digital real estate monopolies of the 21st century.
Man, that is an incredibly provocative way to look at where the real leverage is being consolidated. I love that. And hey, if you are analyzing charts and trying to spot these kinds of market overreactions yourself, remember to check out VIP Algos through the link below in the description. VIP Algos is a TradingView indicator suite featuring visual buy and sell alerts, trend direction tools, and mapped out support and resistance zones alongside take profit and stop loss planning areas. It is purely an educational chart analysis tool. It is not financial advice. It does not execute trades for you, and it cannot guarantee results. Trading involves inherent risk, so manage your capital responsibly and do your own research. This is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.